All right, folks, it is August 12th, and it is time for the August production webinar. If you do have audio, please mute your audio or mute your microphone. I've tried to do that to everybody. If you have video, please disable your video. That would be appreciated. Other than that, I just want to make a real quick note. You can see on your screen here that I have put out a new tentative schedule. For some scheduling reasons, we had to switch the September Director's Cut to Friday, and then we also have moved the remainder of the Director's Cuts to 2 p.m. Later this year. So Friday, September 16th will still be in the morning, but then the remainder of our Director's Cuts will be at 2 p.m. Just a reminder to those of you that might be new on the call, to try to keep it to the content within the Director's Cut or within what Lynn discusses during the Director's Cut. That would be appreciated so we can stay on track here. Other than that, use the chat feature to ask any questions if you have them. I think that is about all that I have. I'll let Mr. Smith place his microphone down. And with that, we will get rolling. So go ahead, Lynn.
She just let the whole world know what time you got here. Good morning, and thank you for attending or tuning in to our August Director's Cut. We're talking June production. Just for everyone who's not familiar, our production reports lag 2 months because we allow operators a month to acquire all their information and put it together and then file at the end of that month, and so that's why it's always 2 months out. I'm going to talk about 3 things this morning in the Director's Cut. The first being oil down and gas up, and then the second is the what I call the full-time Fed watch, and then the break-even prices. We publish those once a quarter, and they're significantly lower, and I think that is worthy of spending some time talking about. So we do have a theme for this month. Some months we don't, but usually we do. And I hearkened back to the old 1980s comedy and the Life Call commercial. I've fallen and I can't get up. The oil prices just really seem to be stuck in this band between $40 and maybe $47, $48. That's unfortunate because we're still looking at a $50 price point for increased hydraulic fracturing activity in North Dakota. And so being stuck in that band is tough, especially during these good weather months when there could be a lot of activity, and that's causing production to continue to slide. And it will eventually flatten out and trend upwards, but not at these current activity levels. So in oil down, gas up thing, we're on trend, the same trend that we've really been following since January of 2015, down 2% in oil production this month, just slightly over 20,000 barrels of decrease, 20,000 barrels per day. We're at the lowest point that we've seen since April of 2014, and we really do expect to drop below 1 million barrels a day pretty soon, before the end of the year, or at the end of the year. It all depends on what kind of activity industry engages in during these summer months. They may be concerned about winter and actually do some things, but been meeting with midstream companies the last couple of weeks, a lot of time spent with them, and they've indicated that operators have been restricting or shutting in production, especially with this most recent price drop. Operators pretty frustrated and not wanting to liquidate their oil assets at those low prices. And so here in the month of August, I'm hearing anecdotally that there is some pretty significant shut-in production or restricted production. So this may be the month when we hit that 1 million barrel a day mark, just based on that, not geologically or anything like that, but just price driven. Natural gas production is up significantly, over 1.1%, and that just speaks to the fact that the core part of the Bakken, where the economics are still very robust, is very gassy. A lot of natural gas produced with the oil. The great news is that gas capture is up as well. So we're back above 90% gas capture. And even though gas production continues to grow pretty rapidly, I think it would be good to kind of look back to when the gas capture program was implemented by the Industrial Commission. Production has doubled since then, gas production, but flaring is about a fourth of what it was at that time. So even with a doubling of production, flaring volumes are about half, and flaring percentage is about a fourth of what it was at that time. So that process has really worked extremely well, focusing investment and activity in the core area where all the gas is being produced. Conventional wells is up a little bit, and that's because we're above $40 West Texas, and that allows for well repairs and production maintenance. But again, that's being somewhat offset, I think, by operators being reluctant to flow wells, especially new wells, at their full volume and liquidate that good production at low prices. Price is down a bit from what it was in July, and that's still the effects of the Brexit hitting us. And I think some good news is rig count is up, and it's a pretty solid up. It's still at May 2009 activity levels, but it's 7 higher than it was at the low point when we got down to 27 drilling rigs. June was a pretty windy month again. Half the month was days that you could not frack a well because of wind. And so North Dakota is keeping up its reputation as a place where there's lots of wind and opportunity there. And interestingly enough, the activity on Fort Berthold ran counter to the rest of the state. Production up versus down, oil production and gas production, and rigs up 1. So it really actually kind of ran counter to what the rest of the state did. Like I said, good news on the flaring. Still one major gas capture project being delayed by some permit approvals, and now it was anticipated that would be going, that Hawkeye Crossing would be going into operation next month, but it's looking like January now before that'll go into operation. How about that full-time Fed watch? Well, lots of new activity in that area. We are still evaluating the Greater Sage Grouse proposed resource management plan. As you know, the states that house the sage grouse had all put together resource management plans, and then the BLM came in and just slapped their own plan on top of it, and it didn't really fit with anyone's plan, including North Dakota's. EPA, yesterday, the Scientific Advisory Board released their comments. It's 180 pages. Their comments on the hydraulic fracturing effects on drinking water study, which has been going on since 2010. And so that just landed. We're going to evaluate that and see if the commission or the state needs to take any kind of an action to avoid some kind of problem with changes in that ongoing study. We joked a little bit this morning that it seems to be the song that never ends. And so 6 years and counting, and just yesterday, a 180-page response from the EPA Scientific Advisory Board. So we'll jump in that loop and take a look at what it's doing. On the environmental organizations that filed the lawsuit for the Resource Conservation and Recovery Act, or RCRA, as we call it, North Dakota led the way in filing a motion to intervene. We've since been joined by the Texas Railroad Commission, Texas Independent Producers, API, and the Independent Petroleum Association of America, or IPAA. Also, we filed a petition for review on the methane rules for new and modified sources, and 13 other states have joined us in that now. And so that's filed in the D.C. Circuit Court. we really are pretty optimistic that the DC Circuit Court is going to push that back to the EPA for a review of that rule, because if you read our comments, you'll see that it interferes with our gas capture program substantially in several areas. And in discussions with the midstream companies, they're seeing some real problems result from companies trying to implement that rule. They're attempting to capture the gas immediately during fracture flowback, and the gathering companies are getting frac sand and salt and produced water into their gas gathering systems. You can almost live with that in the summertime, but in the wintertime, that will be a disaster. And so some modifications need to be made to that rule. And then finally, we are still evaluating whether we need to take any kind of action on the U.S. Fish and Wildlife change to their handbook on how they're going to manage non-federal minerals under their easements and under their wildlife refuges. Lastly, let's talk about break-evens. Significantly lower. And so we put the break-even table at the end of our director's cut. You can see there our break-even price based on second quarter well results and second quarter well cost estimates that we get from industry in our data. And then also, I think it's on page 6, and also during testimony on cases. We also show you the number of rigs operating in each county, the wells capable of production in each county, the number of non-completed wells by county, and then the estimate on a 90% probability or 50% probability of how many wells ultimately will be drilled in that county. And as you can see, we're nowhere near drilling exhaustion in North Dakota, and we've always said this, that 80% of the drilling is still ahead of us. It's just a matter of price. The color coding there is, if you're in the black, it means it's profitable to drill in that county. That you, even at today's oil prices and well costs, you can achieve a better than 10% discounted return on investment. If you're in the gray, it means parts of the county are economic and parts aren't. And if you're in the red, don't be looking for a drilling rig anytime soon, because oil prices just won't support, and the production numbers won't support drilling activity in those 4 counties that you see there. So you're really starting to see the impact of cost cutting by industry begin to affect these break-even prices. And I looked, when I ran them, I was a little surprised that they all dropped as much as they did. They dropped about $5 per barrel, typically. And we've seen a 28% decrease in completed well costs now, along with a 28% decrease in estimated operating costs. So when you couple those two together, you've got a 56% decrease in the cost of producing a barrel of oil in North Dakota, and that really helps. And some of those efficiencies will stick around when prices begin to rebound, and some of them there's going to be some erosion, but that's some pretty good news. So with that, we'll take questions for a few minutes and see where we end up. Thanks again for joining us.
Does the geographical location affect the break-evens in terms of like how long trucks have to drive to get there? What are some of the things that really determine from county to county?
Sure. So the question was geography and how much that impacts break-even costs, along with what are some of the major determinants. And the combination of geography and geology probably is the biggest driver. The well depths vary quite a bit. So Dunn and McKenzie County in particular have very deep wells, and they're much more expensive. So it's a bit of a surprise that they have the lowest break-even costs, or near the lowest, but they also have the highest productivity from the wells. So number one driver is well cost, and number two would be how productive the wells are. We are in a situation now where the majority of oil and water are now moving by pipeline, and maybe that we could get Justin to bring us up to date on that. So it's not so much geography and trucks and roads as it is that combination of geography and geology on well costs and then how much the initial production from the wells is. The Dunn and McKenzie County are extremely productive, with some wells coming in over 3,000 barrels a day. Dunn County, really the best place to drill, except that the Bear Creek gas plant is not on yet, but it's coming on the fourth quarter of this year. So once the gas gathering infrastructure is there in Dunn County, that's going to be a really hot area.
Any thoughts on oil prices staying low for the next 12 to 18 months?
Well, as far as oil prices low for the next 12 to 18 months, I've seen some expressions of that, and it seems like every time we've gotten very optimistic, there's been some reason for oil prices to drop again. But that's by far the minority view. In fact, the markets are beginning to shift to more long positions than short positions. So I think the $40 a barrel trampoline, so to speak, we bounced off of that on West Texas Intermediate. That told us really that there's little to no $20 and $30 a barrel oil in the world. And we are at or very near market balance. The majority of the analysts that I have studied say if we're not at the balance point, we are very, very near that. And the low prices are stimulating demand. So I don't really think, I think that's a very conservative estimate, and that we're going to see oil prices begin to rise before the end of the year.
What are your thoughts on frac crews being added, or any anticipation of frac crews being added yet this summer?
There have been a couple of frac crews added this summer. There is talk of perhaps a couple more, particularly in anticipation of Bear Creek, the gas plant, coming on and doing some completions. But the drop in oil price, and then the message from the service companies that when activity picks up, they're not going to be able to continue the massive discounts that they've been giving, has really dampened that increase in activity. So I think best case scenario is we go from 7 to 9. That's really kind of the best case scenario for the rest of this year.
This question is somewhat of a stretch, but I'm going to allow it because we're talking about completions. But if we get much more in the weeds, I'm not going to be happy. One company, what are your thoughts on using diverter agents and much more sand on frac? Oasis used a record 20 million pounds on a well. Do you think this is a trend?
I absolutely think it's a trend. In fact, in discussions with, again, some of the operators just this last week, they were talking about using diverters on their multi-stage fracs, pumping 50-stage fracs, but using diverters to try to turn those into 150-stage fracs. And then there was a project proposed to the Oil and Gas Research Council to use diverters for some refrac wells. And they were actually proposing a very interesting technology to go into a sliding sleeve completion and use perf and plug with diverters to turn 8 and 10 stage fracs into 30 to 50 stage fracs. It is an emerging technology that has a huge amount of potential for wells in North Dakota. If you recall, there's probably about 6,000 or 7,000 wells, at least 6,000 wells that were drilled in the 2007 through 2011 timeframe that had at best 5 and 6 stage fracs. And so all of those wells are potential for refrac and for diverter agents.
Okay, this is a really good question. Why do you expect production to fall beneath 1 million barrels a day when rig count has been increasing for the last 3 months?
Yeah, so I've been tracking the completions more than the rig count, and that in the mid-40s for completions, we're 30 to 40 completions shy of maintaining production. It takes 70 to 80 completions a month to maintain production, and 80 plus in order to grow production. What we are seeing is a big difference in operators. We've got two large operators who are not purposely turning their wells into DUCs or not completing their wells. On the other hand, we have two major operators, actually three large operators, who are drilling but not completing anything. And they've been pursuing some joint ventures to raise capital for those completions, but they've wanted to preserve their rig contracts and preserve their capital for drilling, and so they're not completing anything. So I'm surprised that the non-completed well inventory hasn't risen more than it has. I still anticipate that happening. It may be, later this year when the weather gets more problematic with fracking, but we're not completing enough wells to maintain production. We're close to drilling enough because they can drill 2 wells a month per rig. So we're very close with the rig count, but not in the completions.
I was going to ask on that note, do you anticipate staying below 100 million barrels a day for an extended period of time?
Yeah, the question was, once we drop below 1 million barrels a day, which is really anticipated, do we expect production to stay there for a significant period of time? And the anticipation in the revenue forecast and as well as our best guess is, yes, that's more than a year before things turn around and we actually build the momentum to push production back in the other direction. So we're thinking that it plateaus or stabilizes around 900,000 barrels a day or a little higher, but that it's going to take a significant amount of time and effort to move it back up again. So we're looking at probably more than 12 months.
For folks who don't know, can you briefly explain what diverter technology is?
Oh, great. Okay. Diverter technology is some new products that the service companies have developed that are either fibers or a material that looks about like talcum powder. It will actually go into an existing hydraulic fracture and plug it off temporarily. It will coat the frac sand that's in that fracture and temporarily plug that off, and it will resist even very, very high pressures. So it forces the frac fluids to find a new place to fracture the rock, to divert. Yeah, it's like a detour sign, a big detour sign. The exciting thing about it is it's built and designed chemically to deteriorate or dissolve with time and the pH of the fluids. So in a high pH fluid or a low pH fluid, either way, it will deteriorate and then dissolve and go back to being water. So it doesn't permanently plug off that existing hydraulic fracture, but it temporarily does.
Any indication of the amount or need for workers increasing or companies holding employees to ramp up later this year?
Well, there is that potential for the addition of a couple of frac crews, and so the demand there, talking with the service companies, that means in the neighborhood of 250 jobs or more, maybe 300 jobs with 2 frac crews and all the associated hauling of fuel and everything there. But where we are seeing substantial increases right now is for workover rigs. And so you saw 98 inactive wells were put back on production. The conventional well count, active well count is up. Some companies are completing wells, and so there is renewed demand for workover rig operators and crews. And happily, the last time I drove to South Dakota for a little time away, I met a couple of truckloads of coiled tubing coming into the state. So I knew that was going to somewhere to complete a well or clean out a Bakken well. So.
Okay, we are getting towards the end. Amy, do you have questions?
Yeah, and one more. You were talking about how we're starting to see the impact of some cost-cutting measures. What are some of those measures?
Well, the cost-cutting measures is what was asked, and to list some of those. The most substantial cost-cutting measure has been the improvement in directional drilling and drill bit technology. Companies are now routinely drilling a well from spud to TD with 3 drill bits and maybe only 4 different downhole assemblies. One of the operators just set a new record with a drill bit. They drilled from the end of the 7-inch casing 15,000 feet, a 3-mile lateral with 1 drill bit. So drilling rig efficiency continues to rise, and we saw 1 month recently where the rigs actually were able to spud and finish 2 wells per rig, and that's a new high. The other place where the cost cutting has taken place is in the hydraulic fracturing. Less chemicals in the water, more sand, but cheaper sand, and then discounts from the service companies. And so we've seen the completion costs go down as well, but the big one is in drilling efficiency. And so 3 years ago, the typical well was $10.5 to $11 million. Today, those cost estimates are $6.5 to $7.5 million. Enormous savings.
Along those same lines, does well length have anything to do with that? Do you hear more about longer, more than 2-mile well lengths, or shorter, less than a mile well length?
We are hearing and seeing more long wells. In fact, we discussed a case yesterday where a company is going to drill a 3-mile lateral. And so one of our engineers had taken a look at, how common is this becoming? And it's still the minority, but we now have several dozen 3 to 3.5 mile horizontal wells. And one of the concerns was, how do those wells perform? Are they able to really frack and flow 3 or 3.5 miles of horizontal lateral? The ones under the Van Hook arm are awesome wells. 90 to 120 days into the productive life, still making 25,000 barrels a month. And so they're very, very good wells. And so we're seeing a significant amount of that, particularly as people are focusing on the core and trying to develop some of those 2560s and those large spacing units that we put together to get under the lake. Keep the wells back a half mile from the lake shore, but drill out under the lake.
In terms of as ramp up would continue, are you expecting the same kind of impact and influx that was maybe seen in 2011, or what type of growth do you expect to see?
Well, we're still looking at 2 different models. One model is the oil price kind of gradually coming back, maybe hopefully hitting the magic $50 per barrel mark by the end of this year, which brings hydraulic fracturing early in 17 and maybe some drilling towards the end of 17 or certainly in 18. That results in rig counts really never getting back to the 218 or 200 plus rigs. There's another model, and that is that we stay at too low of oil prices for too long, and that we see an enormous shift in oil prices to the $80 range and those kind of ranges, and that will bring rig activity back to the 2012 levels and fairly quickly. So we're in our revenue forecasting, we're using the first model, which is kind of slow recovery, but we're talking to communities and counties about making sure that they have a plan B for the other model, which is, what do you do when the crew camps are full again and the highways are occupied by 1,000 semis serving 200 drilling rigs? So we're kind of mixing and matching the models, expecting the slow growth model, but planning for the big one.
Which, of course, you'll be briefing the counties at their annual county update.
Right, that's coming up in October, so we'll talk about that. We'll talk about the 2 models.
All right, well, that is all the time that we have for Lynn, so we will switch gears here and get Mr. Kringstad set up and ready to go. So hang tight. All right, ready when you are, JK.
Okay, good morning, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. I'll get right into my material, updating everyone on what's been taking place on the transportation side of the world in the Williston Basin. So on the production, no big surprises from the neighboring states, continuing to see declines both in Montana as well as South Dakota. Again, those other states sharing the same transportation network as North Dakota, so we always keep an eye on what's happening in those states as well. For June, some slight shifts in the way that crude oil has been moving out of the region. And so you can see again that shift away from rail and more shift towards traditional pipeline routes out of North Dakota. And we also saw some increased truck traffic going north into Canada to get on, presumably, the pipeline network just north of the border. When we look at how that shift has been trending, again, the purple line is the rail market share, the blue line on slide 4 is the pipeline market share, and then down at the bottom, typically that hasn't gotten attention in many years, but that green line is the amount of truck traffic going north into Canada. And so when you combine both the blue line, which is traditional pipeline export, as well as the green line, you see that again, a significant shift continues towards the pipeline network versus the rail network. And again, driving that not only access on the pipeline systems, but then the market conditions as well. So we're continuing to see that Brent WTI price spread hovering, at least in June, right around 0. So when I took a look at estimating how much rail traffic was leaving in June, it's just over 300,000 barrels a day. So again, you can see the trend, nothing changing that trajectory in the month of June. When we look at where that crude by rail is going, we saw a little bit of a shift again between the East Coast, Pad 1, and the West Coast, which is Pad 5. And so Pad 5 had been gaining market share, and then in the month of May, which is the most recent, we saw again a little divergence with East Coast regaining some of that market share for that crude by rail out of the region. Slide 7, the pricing in May. Again, you're taking a look at what refiners were paying on average in those different PAD regions around the U.S. An interesting thing to note would be typically PAD 2 is one of the lower, which is the mid-continent, one of the lower priced markets, typically lower priced than the Gulf, but we saw a shift in May where PAD 2 actually had higher pricing than PAD 3. I don't expect that to continue. That may have been a blip with the fires and supply disruptions in Canada. A lot of that Canadian production comes into that Great Lakes PAD 2 region on either the Trans-Canada Keystone Pipeline or the Enbridge Mainline system. And so with that supply disruption, that was going to obviously have an impact then on pricing. We look at today's pricing, just over $2 spread between Brent and WTI. Again, not enough, in my opinion, to make any major shifts back towards the rail market. If we saw that go up significantly higher, then we would likely see additional barrels be marketed by rail out of North Dakota. But at this time, that doesn't indicate to me that we'll see any major shifts in the near term. Slide 9, this is the hard numbers from the International Trade Commission regarding that truck traffic north and south of the border. Again, you can see in black a significant shift in the way that crude is being moved across the border. We saw exports go up, imports have dropped substantially. Again, I've got a couple contacts out in the oil industry that are also scratching their head a little bit. We're all trying to figure out exactly what's going on. I think possibly the people that do know are keeping that private for competitive reasons. It's likely going to be a marketing situation where market conditions are just simply better north of the border. And so we'll have to keep an eye on this and see if it's a long-term trend or if it was just a disruption or a blip that will correct itself here going forward. Taking a look at natural gas, again, you heard from Lynn the 10% flaring. The breakdown of that 10%, again, majority, that 8% of the gas being flared from wells that are connected to gas gathering systems, and still at 2% is the amount of gas being flared from wells that do not have a pipeline connection associated with them. Then slide 11, taking a look at well connections for the gas gathering industry. Again, continuing to outpace the new producing wells. As you saw from Lynn's material, the new producing wells has been hovering right around that 44, 45 new producing wells each month. And so we'll keep an eye on that to see that the gas gathering industry is continuing to keep pace with that going forward. And then, as I mentioned last month, just an update on what's happening with natural gas liquids production in North Dakota. And this is as of May, the most recent month available. You can see 146,000 barrels of natural gas liquids produced in North Dakota. You can see the breakdown by commodity on the lower portion. So the total is the top longer chart, and then a breakdown of the ethanes, propanes, butane, natural gasoline below it. So you can see what composition makes up that top chart. So with that, I'd be glad to answer any questions.
Let's see, these are both the Canadian questions. Any thoughts on who is taking the trucked oil from North Dakota? And you briefly touched on the fires in Canada. Do you think that plays a role with why it's getting trucked to Canada?
Well, potentially. So as far as the understanding who and to what destinations that crude is being moved, no, the International Trade Commission just has the hard numbers. They don't have any additional details as far as who and what the ultimate destination is. And likely the timing of that, May was when we saw that first uptick. That was the month that Fort McMurray, the fires started growing. And so I don't know that you could rule that out. I would suspect that there's going to be some marketing reason that crude is being moved north of the border. And I believe it's likely going to be associated with, at least in part, the fires in the oil sands region.
They're going easy on you today.
I guess. Well, thank you very much.
Great. Thanks, everybody.